AI is a hot topic today. Chips, software, data centers. But there's one fundamental question that isn't being discussed enough. What is the source of this power? Consider this striking statistic. The U.S. Federal Energy Regulatory Commission estimates that American data center electricity needs will increase from 19 gigawatts in 2023 to 35 gigawatts by 2030, nearly double in under 7 years. This projection was made prior to the latest surge of AI model implementations. Natural gas cannot keep pace. Solar and wind are not continually reliable. The only energy source capable of providing consistent, carbon-free power at the scale required by AI is nuclear. Top technology firms globally are already aware of this. Microsoft has entered a 20-year nuclear power agreement. Meta has finalized 2 separate contracts. Nvidia supports the development of next-gen reactors. China is approving 10 to 15 new reactors every year. Today, we present 5 stocks that cover the entire nuclear energy supply chain. The first stock is GE Vernova. What sets it apart from the others is this: GE Vernova does not sell power. It provides the machinery that produces power: turbines, transformers, grid systems, equipment for data centers. Every nuclear facility, every grid enhancement, every data center energy link in America requires these machines. GE Vernova manufactures them. Envision 5 distinct nuclear operators competing to secure the next power deal with a hyperscaler. GE Vernova has no preference who wins. All 5 operators must purchase their equipment. In the first quarter of 2026, GE Vernova secured $2.4 billion in orders for data center equipment. This amount surpassed the entire totals for 2025 in just that quarter. The total signed backlog now stands at $150 billion. The revenue outlook for 2026 was adjusted upwards to between $44.5 and $45.5 billion. Management revised their forecast higher again after a previous increase last quarter. GEV provides the most secure, viable investment in the AI power infrastructure sector. Next up is Vistra Corp, ticker VST. If you've been following the AI energy sector, you might know Constellation Energy. However, you may not be as familiar with Vistra. Vistra operates nuclear power plants situated in Texas, Ohio, and Pennsylvania. These are functional plants generating electricity today. In 2026, Vistra reached a significant milestone by signing a 20-year power purchase agreement with Meta for 2.1 gigawatts of nuclear power from 3 facilities. This is a legally binding contract securing revenue until 2046. It's more than just a letter of intent or trial program. It's a solid commitment from a top tech corporation. As a result of this agreement, Fitch upgraded Vistra's credit rating to investment grade. Morgan Stanley increased its price target to $212. All analysts covering this stock recommend it as a buy. However, Vistra currently trades around $155, approximately 27% below the average analyst's target. It has the same hyperscaler deal thesis as its more prominent counterpart, shares a similar revenue structure, and boasts a stronger immediate catalyst calendar. The market appears to be overlooking this opportunity. Our third stock is Constellation Energy, represented by ticker CEG. This is perhaps the most well-known name in the nuclear energy and AI sector. It operates America's largest nuclear fleet with a capacity of 55 gigawatts. Notably, it recommissioned 3 Mile Island for Microsoft and secured a separate 1.1 gigawatt agreement with Meta. In the first quarter of 2026, Constellation exceeded revenue expectations by 26%, reporting $11.1 billion compared to Wall Street's consensus of $8.7 billion. The guidance for full-year earnings per share of $11 to $12 was reaffirmed. There are 27 analysts tracking this stock with an average price target of $372. However, there's an important event occurring this week that audiences should be aware of. On June the 1st, a secondary share offering of $3.1 billion entered the market. This isn't Constellation raising new funds, but existing investors monetizing their holdings following a strong performance. When such a substantial volume of stock is available, it may exert mechanical selling pressure, regardless of business strength. Consequently, the stock sits at approximately $265, lower than its 52-week peak of $412. The operational fundamentals remain solid. The long-term thesis still holds. Nevertheless, timing for entry is crucial here. The NRC decision regarding 3 Mile Island is anticipated soon and could be a vital re-rating catalyst. Now, let's discuss Oklo, ticker Oklo. This stock stands apart more than any other on this list, and understanding it clearly is essential. Currently, Oklo does not have operating reactors. Instead, it is developing the next generation of reactors. These small modular reactors are compact nuclear plants intended to be located adjacent to data centers for exclusive power provision. No grid is necessary, no energy loss in transmission, just dedicated clean energy on demand. The company has backing from Sam Altman and partnerships with Nvidia, Meta, Switch, and Equinix. Its customer pipeline consists of 14 gigawatts. In May 2026, the U.S. Nuclear Regulatory Commission approved Oklo's Aurora reactor design on an expedited schedule, representing a significant regulatory achievement that mitigates a primary risk factor for the business. Here's a critical fact. Oklo currently generates no commercial revenue. The company has secured funding 3 times recently, resulting in selling pressure, causing the stock to drop from its peak of $171 down to about $67. Positive developments have not been sufficient to positively influence stock price due to dilution effects. A pivotal test is scheduled for July the 4th, 2026, just 32 days away. A reactor at the Groves Isotopes facility in Texas must achieve criticality, which is a self-sustaining nuclear chain reaction. If successful, it validates the underlying technology and shifts the narrative. If delayed, the stock may decline further. There's significant upside potential if the technology proves successful. The final stock on our list is Cameco, ticker CCJ. Cameco is the largest uranium mining firm in the world. They extract uranium from northern Canada and provide it as fuel to nuclear reactors globally. No nuclear energy exists without uranium. Thus, every new reactor approved, whether in the US, Europe or China, eventually results in long-term uranium contracts for Cameco. The rate of global reactor approvals is rising quickly. China, for instance, is approving 10 to 15 new reactors annually until 2030. By decade's end, China may emerge as the dominant global nuclear power market. Earlier this month, Cameco gained attention for another reason. Flooding in northern Saskatchewan partially disrupted access to the McArthur River mine, one of the globe's most productive uranium sources. Operations faced temporary setbacks. However, the stock remained relatively stable. Cameco resumed full production and maintained its yearly guidance unchanged. This non-reaction highlights how the market perceives this stock's resilience. A significant supply disruption at a crucial uranium site was viewed as inconsequential. This exemplifies a robust long-term investment thesis. The stock has risen 79% over the last year. 11 out of 12 analysts recommend it as a buy. The demand for uranium is a persistent, multi-decade global trend. 5 distinct stocks, 1 comprehensive supply chain, ranging from uranium extraction to the equipment constructing the grid, to the reactors generating the energy, and the long-term contracts already established with major global corporations. This is Signal Stock. Please subscribe us for weekly updates.